Hey guys, welcome back to another episode of the Living in Bremerton podcast. I'm Cassandra Lopez, your host, and a few exciting things to talk about today. So I was listening to another podcast the other day, and it had a lot of really good information about the predictions for the rest of the year and into quarter one of next year. So just to recap what's been going on the last 12 months, obviously interest rates skyrocketed. There's a term that people in the industry like to say, which is interest rates take the elevator up and they take the stairs down, right? So they went from like 2 to 5 in a matter of 4 months, right? It didn't take long. It was ridiculous. So like now they're in the 7s. Some people are getting qualified in the 8s. So they're high. They're high compared to what they were, 18 months ago. And so it's really important to realize that 18 months ago, the 2.5, anything under 3 really is really an anomaly. It's an outlier. We may never see a market like that again with interest rates like that. And so it's really important not to normalize what that was and set that as the new standard, because it's not. I mean, 4s and 5s and 6s, super standard. That's kind of been the norm. Back in the 80s, we were up to 18-20%. So like 7, 8, maybe it's a point or two higher than the norm, because 2s and 3s was definitely not the norm. Granted, we all took advantage if we could, but it's just not the norm. So that happened. Buyers stopped in their tracks. Well, a lot of what happened was the buyers who were locked in, maybe they weren't under contract, but they weren't locked into their rate yet. And then they got priced out of the market entirely because now this new interest rate was going to bump up their payment past to what they could afford. So that happened a lot. We saw a ton of transactions terminate based on failed financing. That was pretty common. Now, a year into it, even though we're in the 7s, people are really starting to normalize what interest rates are. So we're starting to see an uptick in inventory a little bit. We were, 6 months ago, we were hovering around 450 units county-wide in Kitsap County. Now we're hovering around 500 units county-wide. So not a huge increase, but it's a marginal increase that's holding steady. So that's the important thing. Keep in mind that 500 is still about half of where we need to be for a balanced market. So we're still very much low inventory, and ironically a seller's market on paper, because we have so few months of inventory in the hopper. So now that buyers are starting to normalize the interest rates, we're starting to see the market come back to life a little. So, business is steady. People still need to buy and sell homes, especially around here. We have such a high influx and outgo of our service members, Puget Sound Naval Shipyard. We also have a lot of temporary staffing requirements like nurses. We have St. Michael Hospital, which requires a lot of traveling nurses. The shipyard also accommodates temporary orders for people coming from other shipyards like San Diego or Japan maybe. So we do have opportunities for housing needs there, right? So that's steady. We just have a great market for that. It's not like we don't feel the shift. We just are cushioned from it a little better just because we have a lot of those big industries like cushioning our sales and rental markets. But a lot of, why buyers stopped in their tracks was fear of all of this, the unknown, and is the market going to crash? Is this and that, and then on the seller side, it's the fear of missing out. So like maybe sellers felt like they missed out on a super hot market to sell their homes for top dollar, because right now they're selling for, 10 to 15% below where they were 18 months ago. So that's a bummer, right? So we want to make sure that we're selling our house for as much money as we can. And if that means holding on to it and waiting for the market to correct, well, then that's what we do. And that's what a lot of sellers have done. So what happens is that creates all this pent up supply that hasn't hit the market yet. And buyers, there's a lot of pent up demand that hasn't hit the market yet either. So what's going to happen when sellers start flooding the market? So we get this massive boom in inventory, and then buyers are like, oh my gosh, look at all that inventory. And like, there's so much supply now. I can actually find a house that I want. I can find a house that I more than sort of like. Interest rates are down. So we're projecting into next year, right? Interest rates are down. It's going to be a feeding frenzy, you guys. So that's what we're anticipating for like end of quarter one next year into the spring market, which is super important because all of you sellers who think you missed your window when you could have sold during the boom, you're going to have that opportunity again. And then all of you buyers who don't want to pay, between 7 and 8% for your loan, well, rates are going to come back down, and they're predicting to be like somewhere in the 5s. So that would be fantastic, right? Comparatively. And so you can now get your loan for cheaper, and you can have more purchasing power, and you can get the home you want. So that is what we're predicting for end of Q1 into Q2 next year. So why did the Fed raise interest rates in the first place, right? It's all about the inflation. You've heard that 10 ways from Sunday by now. So inflation, what causes inflation? So a lot of things lead to that, like the cost of materials and supply, right? So the more expensive those get, people who use those materials and then pass it on to the consumer, like the consumer ends up paying more, printing a lot of money. So we printed a lot of money last several years, so that leads to inflation. The increase in minimum wage. This is something that not a lot of people are talking about because they think there'd be riots in the streets if they tried to change this one. But increasing the minimum wage here in Washington State, it's like $17 an hour, So obviously that the cost of the employers to pay their employees that wage now is going to be passed on to the cost of the product and then passed on to the consumer paying for that product. So it all gets passed down, right? Because the employers and the businesses and the companies, they're all going to maintain their margins no matter what. So it's all going to pass through. So that all leads to inflation as well. Specifically regarding the housing market, prices were inflated during the high market because buyers were willing to beat out other buyers and inflate the price to get the house, right? So that was sort of like an artificial inflation. That was actually caused by the demand rather than the supply, which is usually the other way around. But that was kind of how that happened. So now what the Fed does is they think they're going to come in and solve the problem by basically targeting the one industry that didn't have anything to do with how inflation actually happens. Like what happens is you target interest rates because it's the easiest common denominator, right? Everyone's got to buy and sell houses. So this is going to be something that affects everybody. We increase interest rates, we reduce buyers' purchasing power, right? By doing that, their payments are going to be higher because more of the portion of their monthly payment is going to be going towards interest, which means they have less money to spend on other things. So now households have less money to spend on dining out, vacations, new cars, like all this stuff, right? Because more of their income is going towards their housing payment. And what that does economically is it's going to eventually push us into a mild recession if we're not there already. So that is the ultimate goal, right, of the Fed, to kind of halt inflation in its tracks and push us into a mild recession, which is actually good for the housing market. So if you look at historically, the trends for recessions, the only recession where home prices did not increase and rates didn't go down was the Great Recession in 2008, which was, again, another anomaly artificially caused by bad banking practices and loan structures. That's a totally different topic that we're not going to get into today. Mild recessions, economic recessions are good for the housing market. So, and there's a difference between an economic recession and a housing recession, which this is not. Just to be clear, we are not in a housing recession and we're not going to go into a housing recession. And I'll explain why in a couple of minutes. But an economic recession is actually what we want. So rates are going to come down. This is how they get us out of the economic recession, is they lower rates. So once rates come back down and then people can start spending money again, on other things besides their housing, then the economy kind of bounces back. So if you think about why they would target the real estate industry, you have to think about how many people and how many jobs and how much money being spent into our economy is dependent on the real estate market. So there's us, there's real estate brokers, there's mortgage lenders, all of their teams. So like showing agents, transaction coordinators, loan processors, the underwriting team. So many people have a hand in those two things. Then there's the home appraisers, there's the home inspectors, there are the title agents and the title reps, there are escrow agents, there are all the people who do like the sewer scopes, septic pump outs, septic inspections, even at the health district level. In Kitsap County, the health district has to come inspect septic systems, so that's down. There is home insurance, so all your insurance agents, all your roofers, all your people who actually maintain the property, so roofers, contractors, landscapers, window guys, appliance guys, flooring guys, painters, plumbers, you name it, all of these guys, every single person who has anything to do with real estate, all of our businesses down this year just because of the way that rates have gone, right? So that's just the nature of being in this industry. So if you think about all of those people, now our income is down. So it's not like the consumer where like our housing payment is higher and so less of our income is spent on other things. Like if we bought a house this year, then yes, but like it's more so our income is down, and so we now have less money to spend on other things. So it's like a different cause but the same effect, if that makes sense. So all of us, all the inspectors and the lenders and the appraisers and the underwriters and everybody involved all the way through who touches every single file of every single real estate transaction, the people who record it at the county, like there's so many people who touch a transaction, a real estate transaction, and now all our incomes are down. So think about how many millions and millions of people countrywide that affects, and how like all of those people have to kind of like tighten the belt, lower the spending, cut quarters, cut costs, like all this stuff, just to maintain our margins and our lifestyles as well. So it doesn't just affect the consumer buying the house, it affects the entire industry, which is why they targeted real estate, because now we have less money to spend in the community, if that makes sense. So, having said all that, when the market does improve, because it will improve, you guys, this is just a minor blip. Like we know historically home prices always go up, right? Like we're not paying the same price for a home today as we did for the same house in 1820. That's ludicrous, right? We would never assume that would be the thing. So of course home prices always go up over time. So right now we're just kind of in a momentary blip in time where home prices are down 10 to 15%, or they leveled off. They're not necessarily going up unless, you're in certain price ranges. If it's very, very well priced and you have a bidding war, we still have those going on, you guys. It's just bonkers. So what's good news for you homeowners who either missed your opportunity to sell in the last boom of the market, and maybe you bought in the last boom. So maybe your home, you paid 2.5% for your mortgage, which is phenomenal. That's like the closest to free money we're ever going to see, right? So a lot of people are holding onto their homes right now because of that rate, right? Like you don't want to sell your house and lose out on that super awesome rate and then buy into a new house that's going to cost you 4 times as much, right? Like who would want to do that? That's not, or at least it doesn't sound like an economically responsible decision. The flip side is to that, a lot of people who did purchase with those 2.5% rates, 82% of them are not happy with their homes in some way or another. That says to me that people settled, that people compromised on what they were purchasing because there were so many other buyers bidding for that same house that they did whatever it took to get that house. And it didn't really matter if they liked it or not. That's what the market did to buyers for the last 18 months prior to today, and then 2 years prior to that. That's what the market did. You got a house that worked. You got a house that you kind of like, but you didn't get a house that you love. And maybe you had to compromise on quite a few things, right? So you would like to move. You would like to sell your house. You would like to get something that suits your lifestyle and your family better, right? But you're holding on to your house because of the rate. And that is not a usual practice. That's not a common reason why people hold on to their homes, right? So we're seeing unusual practices. We're seeing unusual trends based on what interest rates are doing. So it doesn't just affect what buyers are doing, it affects what current homeowners are doing as well. So back to like what I was saying in the beginning, so when the market does improve and rates come down and all these buyers flood the market and all these sellers are like, hot damn, there's a buyer for my house now, I'm gonna put it on the market, I'm gonna get top dollar, which you will. Any market you sell in, you're gonna get top dollar for whatever that market determines what your home is worth. Doesn't matter if we're in the recession of 2008. If you sold your house for $200,000 when the year prior it was worth $300,000, you still got top dollar in your house for that market. So that's an unpopular opinion, but there it is. You're always going to get top dollar because your home is worth what a buyer is willing to pay for it. And if 10 buyers are willing to bid it up 25%, then that's what your top dollar is. If you overprice your home and you have to do a couple of price reductions and then you end up taking a 15% loss off the list price because a buyer said, well, I'm not going to pay you $500, but I'll pay you $475 or whatever, then that was top dollar. So do you kind of see where I'm going with that? The list price that the seller sets is just a suggestion. They're saying, yeah, I'll be willing to take this price. But if a buyer doesn't agree, the buyer will correct it. The buyer is another term for the market. The buyer will correct the price up or down, depending on where you list it, depending on where the market says your home is worth. So that's basically, economics 101, supply and demand, right? So having said all that, right now a buyer says your home is worth 450. Maybe next spring when rates come down, a buyer will say your home is worth 500. Sweet. So let's, if you want to wait it out, if you can wait it out and you want to wait for next year to get top dollar, then that's what you do. So what that's going to do, we're going to have this massive flood of inventory and this massive flood of buyers almost simultaneously. And all that new inventory, remember how I said we were hovering around 500? Well, maybe the inventory gets bumped up to like 750. I have no idea how many of you homeowners are waiting till spring to sell. It could be a lot. It could be like 10. I don't know. But what that's going to do is the buyers are going to very quickly absorb all of that new inventory. So we're actually not going to see an increase in inventory, which is what we need to have because just supply is so low. So we will likely drop down below that 500 mark very quickly. All that new inventory will get absorbed. And then because rates are so favorable, all the existing inventory will now be sold as well. Which brings me to another point of new constructions. Builders right now are offering crazy incentives and concessions, like for rate buy down or appliance packages or upgrades or whatever that you can apply towards your new home. You get a builder warranty, you get a brand new home, all this stuff. They're super affordable. Usually new construction is about 10 to 15% of our overall inventory. And right now it's 50% because resale homeowners are not selling their homes. But builders have the deep enough pockets that they can offer these crazy incentives, still be in the black. Buyers get a win. You get a new house and all these incentives, and they can liquidate their inventory quickly by offering this stuff. So if you would consider like a new construction as an opportunity, that would be a great one. I just sold like 3 in a row. One of my buyers with TriPoint was the builder. They got like $30,000 in concessions, like $30,000 for them to buy down their rate, for them to choose some upgrades, for them to add some blinds or appliances or whatever. It blows me away what builders are offering right now. And if you're not taking advantage of that, you need to at least consider it if you're in the market, because not only do you have like no competition for a new construction, but you get all these crazy incentives and a brand new house. So it's kind of like a win-win all the way around. I would say the only thing to keep in mind is that the yards are going to be small. You guys, these plats are built on postage stamps. So if you need a yard, this won't be a good option for you. Also, many of them are not move-in ready. The soonest ones listed are like 60 days out. So if you need a home like this weekend, not going to be a good option for you unless the home just happens to be done and hasn't sold yet. So usually they're out a ways. Sometimes they're not. I would say that's the exception rather than the norm. So if you need to buy something immediately and move in like right now, this may not be an option. But if those two things don't matter to you, then yeah, check them out. I'm on a first name basis with all of the sales reps because I just like to have good relationships in the industry. So if you need info on a lot, if you need insider info, let me know and I can get you all the information you need on any of those new constructions, because right now they are like an amazing part of our inventory and a good opportunity that you may not want to miss. So all that to say, you guys, like, it's still an amazing time to buy. Like if you can afford the higher payment and it's not going to break your bank, you're going to get a stellar deal on a house. If you were an investor, like I'm an investor, I have 3 rental properties, so I'm always like on the prowl for deals, and I'm always like looking at what the investor market's doing as well. So if you're an investor, I get it. It's hard to find cash flowing properties right now. I totally get that. The important thing to understand is that the wealth is not made in the cash flow. The wealth is made in the equity. So if you can buy a house now, because investor rates are even higher, you guys, investor rates are like at least a point higher than owner occupied rates. If you can swing the high payment right now, maybe you don't cash flow, maybe you just break even, knowing that in 9 to 12 months, because where are we? July 2023. In 9 to 12 months, you can refi that rate several points down, at which point the market will have appreciated and you'll have an amazing amount of equity as well. So you're going to not only have a favorable payment where you can now cash flow, but now you're going to be sitting on tens of thousands of dollars of equity that you didn't have today, which is the whole point, right? Investing in real estate is buy and hold, buy and hold, buy and hold. That's where the wealth is made. A lot of people do a lot of flips, and they make their money that way as well. I would say if you're going to do that, just make sure you're diversifying, because if you're doing a lot of those flips, you're either doing a lot of 1031s, which the facilitators are expensive. You're saving money on capital gains, but the facilitators are expensive, or you're not doing 1031s and you're paying the capital gains, which are exorbitantly expensive. So you're getting the cash on cash return from your flip, but then you're going to end up paying out all these other fees too. So that's just something to keep in mind. So if you're doing that, also hold some for rentals maybe, or also like do whatever. So I talked about previously about why we're not headed into a housing recession, and I meant to touch on this. So like, sorry if I'm like bouncing all over the place, but like it just came into my head. So why we're not going into a housing recession versus the 2008, like why the market isn't going to crash. So for one, the lending practices are so much stricter and so much more transparent than they were back then. Back there, you could say I make $200,000 a year, and they'd be like, okay, here's your loan. Like no verification. You barely even had to show your driver's license, you guys. It was like bonkers. So the reason why the housing market is not going to crash is because one out of three homes is owned free and clear. So you can't foreclose on what you don't own, right? A bank cannot take what they don't own. So 1/3 of properties are owned free and clear. Another third of properties have at least 50% equity, 50% equity in their homes. So I'm in that camp. My primary residence has 50% equity. And by the way, you guys, that happened over the course of the last 6 years. I bought it with my VA loan, 0 down, and now I have 50% equity. So how does that happen? Like you take advantage of the market appreciation. That's literally all it takes. You own a home, the end. You get to take advantage. You now are in the camp of taking advantage of market appreciation by doing absolutely nothing. So that's pretty cool. So if you haven't considered that, then by golly, there's no other reason to buy a house, then that's the one, right? So there's a lot of people with 100% or 50% equity, 50 to 100 in there. And then the rest of the third is they have 50% or less, like less than 50% equity. So that's going to be people who've, just purchased, all that kind of stuff. So there's lots of circumstances for that. Maybe they took out a line of credit, which a lot of people are doing that right now. By the way, a lot of people are taking out lines of credit instead of doing a refinance or selling, because their lines of credit are cheaper right now. So anyway, just something to keep in mind if you want to talk about that later. What a line of credit is, how do you get one, what's it for, what's it do, why is it better, all these things, we can talk about that. So before, people were taking out 80-20 splits. They were doing a first and a second for a purchase. This is before 2008. This is part of what led up to the crash. Stated income loans, they were taking out a first and a second, so they were fully leveraged, zero equity in any of these properties, and then everything just nosedived off a cliff, and then, we all know what happened next. So that's not happening right now because lenders don't let people fully leverage their homes, take out 100% financing, unless it's a special circumstance, like a VA loan or a USDA loan. So there's a couple of options there, but you have to be really, really specially qualified. The home itself has to qualify for the loan as well. So basically, you guys, the moral of the story, still a great time to buy. Interest rates will come down. This is just a minor blip on the radar. We're going to have a really hot market next spring. That's what's forecasted. So if you're selling your home and you're kind of just on the sidelines, if you can wait for another 9 months, then maybe that's what you do. If you're a buyer and you're waiting for rates to come down, then you're going to be waiting about another 6 to 9 months for that to happen. So if you can wait, then that's what you do. I still would encourage you to explore purchasing in this market, because even though you're going to pay a higher rate now, you will get the home for really cheap. If you buy new construction, you get those crazy incentives, and then you just refi later into a better rate, at which point you'll have equity. It'll be a win-win. So a lot of good things coming down the pike, you guys. We're starting to see the light at the end of the tunnel, hopefully. It's been a long haul. It's been a crazy, crazy complex market for the last 12 to 18 months. I see that it's steady still, though, which is really encouraging, because people still need to buy and sell homes, and the market is not crashing at all anytime soon. So I would love to hear your comments. So put them in the chat, put them in the comments below, send me a direct message. Here's my phone number and my email. Send me a comment or like the video or share the video, do whatever you got to do, because I love getting this message out. Because quite honestly, this content does not specifically apply to Bremerton. This is nationwide. You know, I understand that real estate markets are micro. So like what's going on in my micro market is not the same thing that's going on in like Wichita, Kansas micro market, you know, totally different markets. But the principles apply. The principles are all the same. So that's the important thing. All right, you guys. So I'll see you on the next video. I'll see you on the next podcast. Hope you're having a great summer. Bye for now.